Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist of WealthPress. Today's Tuesday. It's October 25th. The market's going to open up in about an hour and 10 minutes. We've got some news coming out today, and I'll get into all of that in a few minutes. If you guys are liking these videos, please subscribe to our WealthPress channel and comment below this video. I really do appreciate it. Now, as I just mentioned, the Dow's down about 197 points. The NASDAQ, let's take a look at the NASDAQ. The NASDAQ's down about 28 points. And the S&P, if I had to guess, is meeting us somewhere in the middle. That's right, down 47. Nothing crazy, but on the Dow, on the DIA, we're down probably about 169 points, about 0.54. Now, this is not unexpected since we've been going quite higher the last few days. Now, big data, we had a fairly reasonable PMI yesterday. It wasn't all that great. And we've got consumer confidence coming out. We've got retail inventories tomorrow. We got durable good and GDP on Thursday. So this is a really important week. As you can see here, the consensus for the consumer sentiment, which comes out about half an hour after the market opens, is about 106. I'd love to see consumer sentiment above 108, 109. That would be really great. If consumer sentiment drops, that wouldn't be very pretty for retail stocks. Put the call ratio, technicals or internals are holding up pretty well in terms of put buyers still overpowering call buyers. Notice this is holding steady and it has not dropped below the 90 level, which is telling me that there's still a lot of upside firepower. That's also confirmed by the number of stocks making 20-day breakouts versus 20-day breakdowns. You've got 212 stocks making 20-day breakouts, 70 stocks making 20-day breakdowns, right? But it's still not 400, 500, 600. So there's a lot of movement potential to the upside, a lot. Let's talk a little bit about global economy, talk about pre-market, what to expect, and we'll take it into the technicals from there. The biggest gainers yesterday were coming from the telecom, healthcare, technology sectors. Keep your eye on the technology sector. Now, a report from the S&P Global disclosed a contraction in U.S. business activity for a fourth month straight. That's something the Fed should pay attention to. Fed officials indicated that the pace of tightening would be debated at the November meeting. And in my opinion, and again, this is just my opinion, they're going to go another 0.75 and then they're going to back off and see how things go. Maybe not even do anything for a month or two and then regain and then see where we stand. But I think they want to do 3 0.75s. And right now, there is only a 2.8% chance based on the bond market's value, because you could look at the basis of the bond market value and you can predict with a very high degree based on its price what the chances of a rate hike is. And right now, we're anticipating with a 97.2% certainty a 0.75% rate hike. So again, 0.75 is going to be, anything other than that is going to be very shocking. 1% is not going to happen. 0.50 is not going to happen. 0.75 will happen. Now, 1/5 of companies have reported earnings so far. 74% are better than expected, but remember what I've mentioned to you guys. It's because they've been beaten down so much. At the same time, analysts expect third quarter profit companies to grow 3% year over year compared to 4.5% increase at the start of October. That was the number that I told you guys to write down. It's going down, not up. That's not good. All focus today is going to be on the consumer confidence. It stands at 106.5. They're looking at 106, 106.5 compared to 108. I'm hoping that the number is better than expected. Chinese Shanghai Composite closed in the red as investors were rattled by Xi's growing power, with China's yuan slumping to a 15-year low. It's not the only currency making a multi-year low. And Bank of Japan's core CPI has been reported at 2%, stronger than 1.9%. It's ironic though, right? Because Japan's one of the few countries that's not doing what the U.S. is doing and is not increasing their rates. And their CPI is actually better. Go figure, right? Earnings. Now, we had earnings yesterday. I'm not going to get into all of these different earnings, but I could tell you this, that as I mentioned, 75 so far are beating expectations. And I'll give you a better update probably on Wednesday. I want to give the companies that came out yesterday, which include Discover, included packaging, including Xeon Bank. Let them marinate a little bit. But today we've got a lot of news, but we've got two big ones. We've got Google that's expecting to come in at $1.26. That's down 10%. Google usually beats their numbers, and revenues forecast at 8.5% higher. But that's not the only thing that's on the table. I mean, aside from Coca-Cola, Corning, General Electric, General Motor, Halliburton, JetBlue, Kimberly-Clark, you've also have this little company called, let's see here, this little company called Microsoft. You guys might have heard of it once in a while. Obviously, I'm joking around, but you got a huge day today. Google, Microsoft, General Electric, General Motors. I mean, so I would rather just wait and report this in a day or two and let the coast clear up. We got Enphase Energy, Pulte Homes. This will reflect very well on the home builders. So expect a lot of volatility, expect a lot of trading range, and expect a lot of market news. So that's happening today. Bond market is setting itself up for a nice little pullback to the upside. As I mentioned here, this downside is extreme, and I mean extreme. So I think I would love to see the bond market go back up to parity of about $1, about a buck on the TLT. I think we will see it. And also, if you look at the stock market, so far, it's pulling up pretty well. Let me just take a look here. So far, I like what I'm seeing. The next area of resistance is 32,500. And I know we're down a little bit today, but I think with earnings being better than expected, I think we're going to rock and roll to the upside, especially with volatility starting to cool off of the 33 level. I think we're moving higher. Now, let's look through individual sectors, and I'll show you which ones I like, which ones I don't. All right. So as you can see here, energy, healthcare, industrial starting to come up, financial and consumer staples. Ironically enough, I like these sectors. I like the financials right now. I like the consumer staples. I like industrial. I like energy, and I like healthcare. Let's look at them one by one. Energy looks like it needs to come off a little bit. It's a little overbought right now. Healthcare looks like it's got more to go to the upside. Industrial definitely looks like it's got more to go to the upside. Financial looks like it could break out a little bit here, and I like the double bottom that's not lower. I like this trend right here. Consumer discretionary is not looking all that great. It hasn't gone above 145 yet. Technology needs to go above 128. Materials need to go above 73. Real estate isn't looking all that great. Utilities are not looking all that great. And communication services is looking okay. But honestly, I like consumer staples. I like industrial, I like healthcare, and I like financial. I really do. I do like those four sectors. And those are the ones that are leading the most right now. Now, let me give you guys some stocks in the sectors that I'm really liking right now. So BIIB is looking good. It's in the healthcare sector, okay? Cardinal Health in the healthcare sector. Genuine Car Parts, I would be careful right now. I would be very, very careful right now because it's on that. It's Genuine Car Parts is consumer is it consumer staples or consumer discretionary? Let me just see real quick. I think it's consumer discretionary, right? Cars. Let's take a look here. Yeah, consumer discretionary. That's what I thought. So you got to be really, really careful, although I like that stock quite a bit. But as you can see here, most Lamb Weston is looking good. Albemarle is looking good. Cummins engine is looking really good. I would stay away from Netflix right now. Cigna is looking good. Globe Life is looking good. Chevron is looking good. Again, AutoZone. Notice car parts are breaking out. Listen, they're breaking out. What are you going to do? Lilly's looking good. Northrop Grumman is looking good. Be very, very, very careful of stocks that are speculative or consumer discretionary right now. So if I was a betting man, which sector would I recommend and put my money in right now? Quite honestly, let me tell you, I like the consumer staples the most. I really do. I love consumer staples. I think they're going to break out, and I think they have more upside regardless. That and industrial. These two sectors. Do I like one better than the other? Consumer staples does better during tough times than industrial. But right now, I'm liking them both, and I'm liking the earnings on the metals. If I had to pick one, it would be consumer staples. Now, let's go back and pick out top consumer staple stocks, okay? So let's go to the S&P 500. And what's the top consumer staple stock? Let's take a look here. Let's take a look. Oh, we go down our list. Now, this is industrial deer right here. Pharmaceuticals, a lot of pharmaceuticals. I like this. This is very, very good right here. CF Industries. Or right here. Campbell Soup. I love this stock. CPB. Let's see how CPB is doing. Oh, yeah. It's near all-time highs. It's ready to break out right now. It looks like it's just sitting there right near the highs. I like this stock. So if I was a betting man and if I was to pick on one stock, CF Industries, which is an industrial stock, or Campbell Soup, which is a consumer staple stocks. Those stocks are really, really hot right now. I know they're boring. I know they're not fast moving, but they're doing very, very well. Another thing that I want to bring to your attention is small caps. Small caps are still in that base. They haven't broken out back, so they're starting to lag once again. But I like the fact that they're in this channel and they haven't broken down yet. So if we could stay here for a while longer, then we will officially call June the end of the bear market, because it doesn't look like we've gotten much lower. I mean, 163.05, 163.22, not much downside. So keep your eye on this sector, on this index and this sector, the small caps, because look at when they officially started going bearish. March of a year before the rest of the market. Look at ARK Fund. Look at when this thing started breaking down. February of 2021, a year before the S&P. Look at this, a year before the S&P. So look at that. Here's the S&P, 122, and look at ARK. Okay, 11 months, not a year, 11 months. But my point is, 11 months earlier. My point is these stocks tend to make highs faster and make bottoms faster. And right now, this doesn't look that much worse than this. We may be very, very close to bottoming out. Stay defensive. Industrial, consumer staples, CF Industries, Coca-Cola, General Mills, Campbell Soup, basics. Stay with the basics, right? Industrial, basic materials. And the worst ones, real estate and communication services. Now, folks, as I mentioned yesterday, I'll be revealing the details of a brand new indicator that I developed tomorrow, 1 p.m. Eastern Time. I call it the quantum indicator. I wanted to call it the master disaster blaster indicator, but they wouldn't let me. So we're calling it the quantum indicator. I'm not kidding. I'm serious. And I think its entry and exit signals could help regular, everyday traders like you develop an edge in your trading. I'm not kidding. I'm not whistling Dixie here. So if you haven't yet, make sure to click the link below, reserve your seat for a training session. As a thank you for signing up, I'll send you my favorite trade idea that the quantum indicator is signaling on Thursday. Why not, right? You get that totally for free just for signing up and using the link below. I'm going to see you Wednesday at 1 p.m. Eastern Time. Don't be late. Don't be square. If you have any questions, email me, support@marketgeeks.com. If you have any comments, or better yet, if you have a question, post it below this video in the YouTube Wealth Press channel, and I'll respond. Have a great, great Tuesday, guys. I'll talk to you soon. Bye.